Hi guys, I hope you are well. I had a little bit of time here. I just got done working out, so I figured I'd go ahead and start the live stream early and try to answer a couple more questions than we typically get to. So let me go ahead and encourage you all to go to rebelcapitalistlive.com. That'll take you to the homepage for the next event that we're doing in Houston, January 7th through the 9th. We've got speakers like Ron Paul, G. Edward Griffin, Mark Moss, Lynette Zhang, Chris Cole, Lynn Alden, all of your favorites from the Rebel Capitalist show. So check out Rebel Capitalist Live and get your tickets while they're still cheap. There's kind of a progressive scale. So if you buy them now, it's cheaper than if you buy them closer to the event. So, all right, let's dive into your questions for today. What would you do if you lived in a country where you were not allowed to buy food unless you were vaccinated? I would move. That's a pretty easy question to answer. How do you invest for increasing consumer price inflation but deflation? Just the same as I always invest. It's that 10-80-10 portfolio, because if you think about it, if you've got 10%, and this is aside from your cash position, so everyone's cash position is going to be different based on what they think the probability of a deleveraging from an inflation standpoint or a deflation standpoint actually is, and what their time horizon is, and what their income and their objectives with their portfolio, and a lot of it goes a lot of variables in there to make a good decision as to what your cash position should be. Then once you determine that, then with your investable assets, you've got 10% in gold and 80% in things that pay you to own them, and then 10% in speculative assets that hopefully there's some good asymmetry there. You're buying things when they're cheap and selling them when they're expensive. But the gold side of your portfolio, that should do well if we have an inflationary deleveraging. So you just think the 1970s. And then you say, okay, George, well, what if we have a deflationary deleveraging like we had in the 1930s? Okay, well, now you've got a cash position. And I'd like to also point out that the stock market didn't go straight down for the entire decade. It went down initially, but then went back up. The whole decade of the 1930s wasn't even deflationary. For the large part of the 1930s, consumer prices were actually going up. So it's kind of it's a little bit of a fallacy that we just think of the 1930s as this deflationary decade. It's just not true. The beginning portion of it was, but the middle and then toward the end, you had another bout of deflation as it was measured at the time. But then you have more inflation going into the 1940s. So anyway, in that type of environment, then all the stuff that you have that's paying you to own it, that's great because you're being paid in dollars. There might be some downward pressure there. But even in that environment too, the gold should do okay because it should decrease in price, but most likely decrease in price less than the assets that you're wanting to buy. Let's just assume stocks because we have a big down market. Let's say a 60-70% bear market. But then your cash, you've got opportunity. You've got you might have a negative carry on the cash if we have consumer price inflation like we've seen in 2020 and 2021. But I think as long as you've got the gold, and especially if you got a 30-year fixed rate mortgage, you've got a lot of hedges there, like short dollar positions, basically. To have that cash for dry powder to take advantage of a big, 20, 30, 40% down move in the stock market, to where those items that are on your watch list become very cheap, I think it's worth it. But to what degree is a personal decision that I can't even give you advice on because I don't have enough information. Raul Paul says social tokens will be bigger than DeFi. What do you think about million token and other social tokens? I don't know, Mark. I don't know, man. I've never heard of a social token, and I'm not sure I want to hear what a social token is. It sounds it sounds very incredibly Orwellian. I don't know. I mean, bigger than DeFi. I don't know what quote unquote bigger means. I don't know. I'll just leave it at that. Just because in my head right now, I'm just getting frustrated by something called a social token. I hope it's not what I'm thinking, but geez, just another Orwellian nightmare. Status on the Fed, FOIA. You got a forensic accountant trying to ask the Fed for documents. It's a long process, but I should get Barnes back on here in the next few weeks to give us an update for sure. Do you think it's probable Biden dishes out billions more in rent relief and takes off the handcuffs, preventing the current funds from being distributed to landlords? Yeah, I mean, I think it's highly probable that Biden continues to dish out billions. In what form, I don't know, but you've got to get those dollars into the real economy to make up for the lack of dollars being created by the commercial banking system. And, you know, just understanding what money is and what dollars are is an incredible challenge. In fact, out of all the macro stuff that I talk about and that I have talked about since this channel began, I think that's the most difficult to understand is money and how it's no, I'm talking about money. I'm not talking about the true definition. I'm talking about just dollar bills, what most the average Joe and Jane considers to be money, right? Just the dollars that are in their checking account, let's say. What is it? And how is it created? How is it destroyed? Who has control over it? And how do you measure it? It's because, see, what you're trying to do is you're trying to measure purchasing power. Well, okay, how do you measure? You know, your credit card is basically untapped or unrealized dollar creation. You know, when you're extended credit in the form of your credit card, they're essentially creating dollars that did not exist before. So is that money? And then when you pay it back, then you're decreasing the amount of dollars in the system. And then if you say, well, yeah, George, obviously that's money. Okay, well, then is a reverse repo? Is that money? Is that destroying money? What about a repo where the counterparties are both in the private sector? Is that money? I mean, you know, what about the ghost ledger that I was talking about last week on the Rebel Capitalist channel? The ledger system between banks that might not have an account with the Fed, or maybe they do. Like as an example, a community credit union, they don't have an account with the Fed. So when they issue, when a bank sends them a liability. So let's say that you're banking with Wells Fargo, and someone that you're buying a car from for $5,000 banks with a credit union. So you have Wells Fargo wire the credit union the $5,000. Okay, well, their Wells Fargo is sending that credit union a $5,000 liability. So they can't just send them a liability. They also have to send them an asset. Well, what's the asset? How can it be a bank reserve if they don't have an account with the Fed? And the asset is simply an IOU in the form of dollars from Wells Fargo to the credit union, just like they each had an account, a checking account with one another, and that they just basically settle up at the end of the night between each other. And as long as the credit union accepts the IOUs, the dollar IOUs, as an asset from Wells Fargo, then it is. Then that's all that has to happen, because at the end of the day, all dollars are just digital entries on a scoreboard. And so if both entities agree on the score, then it is what it is, right? So since the credit union is basically issuing Wells Fargo credit, is that money? It's increasing the purchasing power of Wells Fargo to a certain extent, because then they can use bank reserves or whatever asset they maybe would have had to sell or give to the credit union. Then they use that for something else. You see, so that's creating more purchasing power. The swap lines. Look at the swap lines that the Fed has that they set up. Now they're creating a permanent repo facility, which they've had for quite some time, but it was quote unquote temporary. Now they've made it permanent with overseas entities, mostly banks, of course. So when those entities do a repo with the Fed, the Fed is issuing them dollars, let's say, that go out into the system, and they are just taking the collateral that entity or sovereign, that country, whatever, had held at the Fed. They're using that as collateral. So how is that tracked in M2 money supply? You see, so just when you're trying to figure out how to define money the way most people think about it, it's very, very hard to do. And if you can't define money, there's definitely no way to quantify it. And if you can't quantify money, then how the hell do you quantify GDP? How do you do anything in economics? How do you try to predict inflation or deflation if you don't even know what money is, if you can't even quantify it? If you can't quantify the dollar purchasing power that exists not only in the world, but just in the United States. You see, so that's why one of the main things I try to teach with my channel is, and hopefully I've imposed this on most of you watching this live stream now, is you got to know what you don't know. And having that humility will help you understand and prioritize risk management with your portfolio. And I think that going into the next 5 years, the greatest asset that you can have as an investor is risk management. So I'm not sure how on earth I got off on that tangent. But my point, I guess my point, Harry, was yes, I think Biden will dish out billions more because they have to continue the deficit spending and most likely increase the amount of deficit spending to kick the can further down the road and to just give more heroin, monetary heroin, to the heroin addict. And if we had the commercial banking system creating dollars at the same rate they were prior to the GFC, or at the same rate they were creating in the 1970s, then holy cow, you want to talk about inflation. I mean, the inflation that we have seen in 2020 and 2021 is nothing compared to what we would see if the commercial banking system started creating dollars at the same rate they were creating dollars, that same trend, if they followed the same trend line that we saw prior to the GFC. And I'd also like to point out that prior to Weimar Germany's hyperinflation that they had in roughly 1923, 1920 to 1922 in Weimar Germany was an economic boom like very few we've seen in history. You know, and I'm not just talking about nominal GDP, I'm talking about real GDP. And most people don't realize that the mark appreciated in value against the dollar during that time frame from 1920 to 22, just before the hyperinflation went parabolic. And so I think what might have happened there is you had the government deficit spending just at insane levels starting in 1914. That's really when the seeds of the hyperinflation were sown. But asset prices kept going up at a higher rate than the rate of consumer price inflation. So they thought that they had stumbled upon an economic miracle where they could get richer without having to work harder. That doesn't sound familiar, does it? So I think what happened is the banks, probably 1914 to 1920, were very hesitant to create loans because of the rate of consumer price inflation and the rate of money creation by the government. But in 1920, they said, hey, to heck with it. Let's get back in the game here, throw our hats in the ring, because we're missing out on a lot of opportunities. And maybe this is an economic miracle. Maybe this money printing thing does work. And I think then they started to lend to a significant degree. And that, on top of what the government was doing, was sustained over 2 years, could have been the catalyst that, along with a lot of psychology, that took Weimar Germany from very low rates of inflation to 1 year later, their currency being literally toilet paper. So you see, and to give you some specific numbers on that as well, the government was or their M2 money supply, the way it was measured, was increasing by about 65% per year, 65%. And you say, well, George, that's astronomical, and you're right. It is. But in 2025, or excuse me, in 2020, the way we measure dollars in our domestic system is M2, and although it may be flawed, it increased by 25% in 2020. So I understand 25% is not 65%, but it's a heck of a lot closer than we were the year prior. So, you know, why can't we get up to 65%? Well, we absolutely could. I don't, especially if, you know, the Republicans capitulate, and the Republicans have basically turned into Democrat light. Or yeah, the Republicans actually are what 10 years ago, what would have been a Democrat, that's pretty much middle of the road Republican right now. And then what was a middle of the road Democrat back then now has become basically a socialist. So the whole political establishment in the United States has moved way to the left, and that includes the Republicans. I mean, just look at what they're talking about. I mean, they're talking about, they're squabbling over the Republicans only want to spend $2 trillion, and the Democrats want to spend $6 trillion or whatever it is, right? I'm just throwing numbers out there. But how is that Republican? That's massive government expansion and an increase in the government spending as a percentage of GDP. And that's what the Republicans want. So the days of Republicans being the party of small government is completely gone. I mean, that was gone with Trump. That was gone way before Trump. But you know, so it's not necessary. My point is, I don't think that you're going to have a lot of gridlock when it comes to the amount of deficit spending we see. It's just a matter of to what degree do we get the deficit spending? And I think that it'll be like a drug in the sense that the more they spend, Democrats and Republicans, without seeing a type of what would be considered a hyperinflation or a stagflation, the more incentivized they will be to print or create more or spend more and more and more dollars into the system, because they, like the Germans before them and everyone else before, they think that they've stumbled upon a free lunch, that we can spend all of these dollars and there's no downside. That yes, we may have some consumer price inflation here, but it's all transitory. And who cares if asset prices are going up by 20% per year, but the cost of living is going up by 5%, 10% per year? Who cares? We're getting rich. Just go buy assets, you dummy. Just go buy Facebook. Just give your money to Cathie Wood. Buy Tesla. And just sit back and get rich and enjoy. It's the exact same thing they did in Weimar, Germany in 1920 to 1922. What would the effect of a central bank digital currency be on mortgage-backed securities if the Fed is using it to give out home loans to people with bad credit? Well, what would the effect of central bank? I don't know that the central bank digital currency would affect mortgage-backed securities, because the issuance of the loan by the Fed would just be an asset on their balance sheet, just a liability on the balance sheet of the private sector, the entities that were doing the borrowing. And I don't know that that would get securitized. In fact, my guess is there's no way it would be securitized. I shouldn't say that. I should say the probability is very low that it would be securitized, because the assets on the Fed's balance sheet, there isn't a collateral multiplier on the assets in the SOMA portfolio. So if a money market fund does a reverse repo with the Fed, and the Fed gives them T-bills, they cannot sell those T-bills, even if it's a term repo, which most of those repos are overnight. I think maybe even 100% of them are overnight. But even if it was a term, the money market fund would not be allowed to sell that treasury as collateral that they got from the Fed. Where if the counterparty was the counterparty to the repo transaction was in the private sector, they absolutely could sell that treasury T-bill. It could be rehypothecated many, many, many times. So in my conversation with Snyder, we talked about a collateral multiplier. And essentially, it's just fractional reserve collateral instead of fractional reserve banking. And so another thing that we need to think about, and another reason to ask yourself, what is money? Because as the collateral multiplier goes up, so does the access to additional purchasing power denominated in dollars. So is that money? How do you measure that in M2? You see, you got to know what you don't know. But let me get back to the topic at hand. Now, the central bank digital currency, I don't see that. I just see that as a one-to-one transaction with the Fed and the private sector. I think that a lot of people will still go to normal banks to get loans, and those will be securitized. So you'll still have that type of collateral, but I don't see the central bank digital currency interfering with the system the way it's built right now. I think you layer the central bank digital currency and the loans coming from the Fed on top of what we already have. So if you can't get a loan from your bank, then you can go to the Fed. Or if there's a specific group that has political favor at the time, then they can go directly to the Fed and potentially get a lower interest rate if they qualify. And obviously, well, I don't have to tell you who those groups might be. you know the groups I'm talking about. The groups that we'll just leave it at that. Have political favor right now, or at any point in time. See, that's the problem. Is that the people on the left may say, oh my gosh, that's fantastic that this group is receiving a lower interest rate, as an example, or that we're using the Fed's printing press to help XYZ group. That's great. But what they forget is that when you give the Fed the power to do that, then when the person or the party that you don't like is in power, then the political favor switches to all the entities that you don't like. You see? So the real solution is not better government. The real solution is smaller government. That by definition is better. You see? And that's what most people that favor big government, they just don't think about. They don't think about what happens when my guy or gal is not in power. Because then that power that I just granted to whomever holds that position is going to be used against me and against the groups that I favor. And that's, so whether you're on the left or right, that it doesn't, it's just smaller government is what you should be for. Do central banks actually need the Fed? Can they survive without it? Reverse repo seems like a pushback. Do central banks actually need the Fed? I don't know that I follow the question. Do central banks actually need the Fed? Honestly, I don't think anybody needs the Fed other than the government, because the Fed can help them monetize the debt. Well, this is a very difficult question because again, it's not do they need the Fed, but do they literally need the Fed or psychologically? Because that's a completely different question. Again, let's go back to the conversation I had with Jeff Snyder recently, and we were talking about although the Fed is basically impotent from a literal standpoint, from a psychological standpoint, they are not. They can manipulate the market and get the participants to take a specific action purely based on expectations policy. And in the sense that quantitative easing may not do anything in literal terms. It's just a swap of assets. Treasuries for bank reserves. So what? But just them doing that and them talking and jawboning the market or inflation or rates or whatever, that does have a psychological impact. And that psychological impacts gets the market participants to actually take action. So do the central banks need the markets? Do the central banks need asset prices to continue to elevate? Do the central banks need those things that the Fed provides from a psychological standpoint? I don't know, because you always say that the central bank isn't central, and the Fed is without question, they are not central to the dollar at all, or the way the system normally works with the commercial banking system creating the majority of dollars. Now, I would argue they are important because there's so much deficit spending that's going on by the government. But I think those are, you're asking about 5 different questions there, all very good questions, but I could go on for the entire hour about that. So just simply put, can they survive? Yeah, I think they can survive. Reverse repo? No, I don't think reverse repo has anything to do with other central banks. But just remember that what the Fed actually does that has an impact is all psychological. I think that's the best way to look at it. What are your thoughts on China stocks? I would consider putting them some on a watch list. I haven't done enough research to give you an opinion, but you got to buy stuff when it's cheap and sell it when it's expensive. Now, sometimes things are cheap for a reason, because they're not a very good asset. So you have to differentiate. But a lot of times, all ships in the harbor go up and down with the tide. And so just because the Chinese come out and say that the education companies can't make profit, that could take some other stocks that might not be in that field down with them, and they could have an unjustified low multiple as just because of fear. And so I'm not saying that there's any that fit that category, but I would start looking around. If I had the time and I was an active investor, I would definitely be looking around and trying, maybe not pulling the trigger now, but definitely getting a watch list together. Okay, guys, if you've got a question, make sure you start with the word questions, and then it's easier for me to pick out. Hi, what it's with what it's with Nasdaq, or what's with Nasdaq 100? How high can it go? I mean, it can go. The market can remain irrational longer than you can remain solvent. It can go up for an indefinite period. I mean, I don't. So again, I don't think that's the right way to look at investing. And so many people, that's their default position. It's they look at something and they just try to figure out if the price is going up or down. I tell you what, I personally, like Jim Rogers says, I think that's a quick way to the poorhouse. If you're sitting there and your first question when you're looking at investing is just, do I think Bitcoin? Do I think the price is going to go up or down? Well, the price is definitely going to go up, so I'm going to buy it. Or if Bitcoin replaced with anything, gold, or oil producers, oil for that matter. Oh my gosh, oil is definitely going higher. So, I mean, the price is going to be at like $150 for sure within the next year because of this and 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 this. So I am definitely buying oil right now because the price is going to go up. I think the price is going to go up in the future. So, and just for the people on the live stream right now that can't sense my sarcasm, that's an example of what not to do. That whole last 2 or 3 minutes, that's what not to do, in my opinion. So the correct question is not, oh my gosh, oil is definitely going to go up in price, or oil is definitely going to go down in price, or whatever. It's just to simply ask yourself, right now, is oil cheap? Not compared to itself, historically speaking, adjusted for inflation. And not that people think that the word cheap means, oil is cheap right now at $75 a barrel, let's say, because supply, blah, 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 blah. No. Oil's cheap or it's not. There's no, it's cheap because of supply constraints and this and this and ESG and blah, 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 blah. No, that's not why, to me, that's not why oil is cheap. Oil is cheap because you look at a long-term chart of oil adjusted for inflation, and you see that the median price is roughly, let's say, $60, $70. And throughout history, when oil gets below $30 a barrel, what does it do? It rebounds up. And throughout history, when it gets above $80 a barrel, it can go up to 100, 120, 150, but it always comes crashing back down. So, and this is regardless of what's going on right now with the fundamentals. So it's a very simple question to ask, right? Is oil cheap right now? No. It's just not. It's not. So is it expensive? No. It's not expensive yet either because it's not above 80. It's nothing. It's just in the limbo zone. So when stuff is in the limbo zone, it's I don't do anything because you got to buy cheap and sell expensive. And if there's nothing that's cheap or expensive, then you're doing nothing. You're waiting. You're just being patient. But so how high can the Nasdaq go? I have no idea. It can go up 10 times. It could go up 100 times. I mean, we get hyperinflation. It could go up almost infinite times. But I think the question is that you need to answer is the Nasdaq 100 cheap or is it expensive? And if it's cheap, buy it, which it's not. If it's expensive, sell it. And you say, well, George, it's tough because I can't get inflation. Well, just look at the normal PEs. Start there. But that's another reason why I really like commodities, because you can compare it, that you've got an apples to apples comparison. With businesses, it's a little harder. Have I invested into ETFs lately? No. I honestly, I don't buy stocks that often. I mean, once every few years, really. And no, I haven't bought anything since the cerveza sickness. So March, April 2020, that's the last time I bought. Because I not only do I like to buy things when they're cheap and sell them when they're expensive, I just really like to not do anything unless I see panic. And when I see panic, then I usually pull the trigger. But I mean, we don't have any panic right now, so I've just been waiting. I was hoping we'd get some panic in Bitcoin, which we did, but I was hoping we'd get some extreme panic where you would start to see some capitulation from some of the Bitcoin maxis, and that's when I would have liked to buy more. But no, so I don't invest. I haven't invested in anything in quite some time, other than Chris Cole's new fund. I invested in that. What was it? Maybe a month ago, or maybe 2 months ago. So I put money with Chris Cole in his fund. So that was an investment. But usually when I'm just managing my own money, it's just I wait for those big panic occasions, and then I come in and buy a lot. Is Colombia the only South American country on my radar? Well, I mean, from what standpoint? A standpoint of living or real estate, or I'm not sure what the exact question is, but no, you've got some great places in Argentina, Brazil. I wouldn't touch Ecuador. I just I just don't think it's it's worth your time. But Colombia is definitely my favorite. That's for sure. Do I hold XRP? No. Could I have a look at a cheap? No, no. I don't really do deep dives on individual stocks. You got to go to Lynn Alden. Go to her blog, and she does stuff like that. I don't really get into that. What do I think the next trigger could be? Well, I mean, trigger. Triggered what? I'm not quite sure. I liken the trend to wean ourselves off fossil fuels as similar to hate cigarette companies. Would you? I would totally agree. Yeah, I absolutely totally agree. In fact, I see parallels not only with fossil fuels. Most people think of oil, but maybe even more so coal. And I absolutely own coal stocks. I bought a lot of coal shares back in March of 2020. I bought a lot of uranium, coal, oil, obviously, and so yeah, I totally see the similarities, and I'm that's very exciting. There's not a lot of things that excite me about the market right now, but that is one thing for sure. This ESG movement taking so much capital away from the future supply of coal and oil, and just making it harder for those newer companies to compete with the ones that are already established, and therefore the ones that are already established get all the business and all the profit, which is basically what happened with the tobacco companies in the mid 1990s. And but I still wouldn't buy an oil producer at these prices, because unless there was a massive dislocation between the price of the producers and the price of oil itself. As an example, let's just say that the price went, because of this ESG movement, there was just absolutely zero capital going into the producers. And you could get like a 15% dividend yield or something like that with one of these oil producers, but oil was still at, let's say, 60. So kind of in just the zone where I don't really buy or don't really sell. I would consider it then, because now what you're doing is you're just buying the cash flow, and a 15% dividend yield, take that all day long, right? You're buying a cash stream. So from that standpoint, you could care less about what the price of the oil company that you're doing, that you're buying does. Like who cares? If you bought an oil company at $30 a share, but you're getting a 15% dividend yield, and the dividend is strong, who cares if the price goes from 30 down to 20? Like you're not selling. You didn't. You you just bought an income stream, so don't sell it. So that income stream becomes incredibly cheap. Another example I would use to illustrate that point is the real estate market going back to 2012. And everyone thinks that real estate back in 2012, adjusted for inflation, was super cheap. It wasn't. It wasn't at all. It just went back to its historic trend line, which wasn't expensive, wasn't cheap. But what was cheap was the cash flow. The cash flow was incredibly, incredibly cheap at the time. And then, of course, the debt was as well, but even more so the cash flow. I just use search engine. The question is, where is a good location for research and data? I just use a search engine. Well, okay, so the question is, with Janet Yellen announcing the debt limit the debt limit reaching its limit, do you think the Fed will print more money to pay off the debt starting tomorrow? Is transitory deflation, or I think inflation? I think you're getting confused here. But no, I don't think the debt ceiling. Do you think the Fed will print more money to pay off the debt? No, because they can't. It's not a matter of the Fed printing money to pay off the debt. It's about the Janet Yellen being able to issue more treasuries at auction. That's kind of what the debt. But they always raise the debt limit, so I wouldn't lose too much sleep over that. Is the transitory, maybe inflation, I think is what you're talking about. Is transitory inflation over? And I think that's just a question of how much government spending do we get. Does it continue to go up the way it's gone up? Do we go from 5 trillion in 2020 to 10 trillion? If we do, then yeah, is the transit, or then no, it's definitely not over as far as transitory inflation. Then I guess it wouldn't be transitory, would it? But if the government, let's just say, stops spending money right now, and all the new dollar creation goes back to the commercial banking system, then I think inflation is definitely transitory. And although it still doesn't, I don't think we get lowering prices. I think that you just get that moonshot of inflation, and then it levels off and maybe starts to go down slightly as far as the rates of inflation. But the damage has been done. Even I find it fascinating that all these financial commentators on the mainstream media talk about is it transitory? Is it not transitory? Is it that? Listen, what do you care? I mean, I know that we care for the future, but let's look back and let's say that the prices of the stuff that you buy daily has gone up by 15% in the last year. Oh, well, that ain't changing. Like, even if inflation is transitory, that 15% increase is done. That's already baked into the prices. Those prices are not going back down. Now, maybe some assets, they will. Maybe housing, maybe stocks, bonds, maybe gold or oil for commodities. Maybe there is price deflation there. But listen, the prices that you paid for stuff is never, ever, ever, ever going back to what it was in 2019. That's my point. Never. It's going one way, up. Now, whether that's a result of disinflation or deflation in the future being less than the inflation we had over the past year, it doesn't matter. I don't think that prices will ever go back to what they were in 2019 for the stuff you buy daily. Because even if the supply chains are fixed with the commodity space as an example, you look at lumber. Okay, that's fine. But the economic distortions that have been created by the government spending, deficit spending, 5 trillion, or the distortions of the economy that we have now that have been created as a result of government spending going from 40% of GDP up to 60%, that doesn't go away. That's going to be with us forever until we get a new system, or until we get a massive deleveraging where all the malinvestment and the misallocation of resources, or the malinvestment more so, that gets completely wiped out of the system and you start clean. So the economic distortions are just compounding on themselves. And why is that important? Because the measurement of wealth in a society is the measurement of the goods and services that it can create and produce efficiently. And you got to ask yourself, whether it's rent forbearance, or whether the mortgage forbearance, or the eviction moratorium, or the child tax credit stimmies, the stimmies, the additional unemployment. Just when you look at a headline like that, you just simply have to ask yourself, does this government program, is this going to create a society that will produce more or less goods and services in the future? And pretty much everything the government has done since 2020, it's a simple answer. Everything they've done has created economic distortions where society will produce fewer goods and services. Therefore, by definition, our standard of living decreases and we get poorer. That's really, in my opinion, how you've got to look at things to distill it, to distill the ideas down to their simplest form. Because a lot of times you can look at the stimmy checks as an example, and you just go around in circles chasing your tail, trying to figure out what the ramifications are going to be, the economic ramifications. Well, it increases demand. So does this mean that the store producer is going to have more profit, and therefore they go out and hire more people, and blah, blah, you're running around, oh my gosh. But if that happens and this happens over here, it's just use the KISS strategy. Just keep it simple, stupid, right? Is this program going to create a society, or incentivize a society to create more or less goods and services in the future? Taxes, same thing. More or less goods and services in the future. Just government regulation. Simple. more or less goods or services in the future. And what you see is 9 times out of 10, any action that a government takes, it's going to create and incentivize a society to create fewer goods and services. And so that's, again, goes back to what we were saying earlier. The solution is not better government. The solution is smaller government. Because better government, even if you can achieve it, will only be better for a very limited time frame. Because eventually you're going to get a guy or gal in office or an entire party that has the power now to completely deconstruct or completely destroy the gains that were made by the government, which actually improved the situation. That's the highest probable outcome. It's not guaranteed, but it's highly probable. And that you're also going to attract a type of person who has an insatiable lust for power. And usually those people are not what comes to mind when you think of better government. Do you think, let's see, George, you are fighting maybe central banks planning that seems to be inevitable. Instead of trying to fight the system, how about trying to find ways to survive? I don't know, man. You're talking to a guy that's tagline for the entire channel is helping you build wealth and thrive in a world of out of control central banks and big governments. So I think I'm covering hopefully the survival component with the whiteboard videos and the interviews that I do. What's my thought of reverse repo reaching $1 trillion? I think it's just a sign that there's counterparty risk in the system that might not be blatantly obvious to those that aren't in the system, that aren't there in the trenches, let's say. It doesn't make sense to me that the reverse repos went parabolic in just a 2-day period. That there's not, it can't just be there's excess liquidity in the system or too many bank reserves or whatever. It's just it doesn't make sense that we just that 4 trillion is okay, but $4 trillion $1, oh my gosh, that is way too much. Let's put $1 trillion of this in repo immediately, or reverse repo. You know that I don't buy that. If it would have happened gradually, then okay, I get it. And if it would have kind of correlated with the size of the Fed's balance sheet, okay, that makes a little more sense to me, but not for it just to happen all at once. And then the collateral issue, I mean, I get that, but there again, I mean, doesn't the collateral issue, in a sense, go back to counterparty risk? And that if you those, because if you think of the collateral multiplier that we were talking about earlier, the collateral, we should not have constraints on the amount of collateral if the banking system was functioning the same way that it was functioning prior to the GFC, meaning that it wasn't broken, because you'd have an increasing collateral multiplier. And so I don't know that the question is, figuring out there's not enough collateral or pristine collateral. I think that's part of it, but I think you got to dig a little deeper and say, well, okay, well, why is there a shortage of pristine collateral? And then again, where I always land is counterparty risk, because if you're decreasing the collateral multiplier, and that is showing up as a signal that there's not enough collateral in the system. Well, why is the multiplier decreasing? Because the multiplier is decreasing because the entities doing the multiplying see more risk in the counterparties that they're dealing with than they did before. So I don't. I maybe I'm overthinking it, but whenever I see reverse repo going to $1 trillion, all I think about is there's got to be some additional counterparty risk in the system, or there most likely is some additional counterparty risk that we're just not seeing. Kind of where there's smoke, there's fire. But one thing I do know is that it is not an issue of too much cash in the system, too much liquidity, too many bank reserves, too many dollars. It's not what the mainstream media is telling you. Okay, so if I lived in a country that didn't have fixed rate mortgages, I just wouldn't play the game. Um, it doesn't make any sense to me, unless you're living in a country that has very little debt in the system. So Colombia, as an example, there I would not have a problem owning something with cash, because number one, real estate's doesn't really inflate there. It's pretty darn cheap when you look at it relative to incomes, and when you adjust for inflation and whatnot. And the rents are good, cash flow is good, but I wouldn't have a problem being there because there's just almost zero debt in the system, and they create inflation. Sure, you're not going to be making money because you don't have a fixed rate loan. You're not going to be increasing your purchasing power there, but I think your downside's lower. Would I own an asset? I'm assuming you're in Canada. Maybe, well, rate's 4%. Yeah, maybe you're in New Zealand or Australia or something. Um, I, I just wouldn't play the game, because you most likely, if you're in the Western world, are in a country where the housing prices are at all-time highs, and I don't like to buy stuff when it's at its all-time high. I just like to buy it when it's cheap and sell it when it's expensive. And I think, like in the United States, the asset is the debt itself. The liability is the property, because prices are so high. So basically, what you're asking me is, George, would you buy a property that was a liability with a liability, which is the debt, which is a non-fixed rate loan? And I would say, no, I don't want two liabilities. I want an asset and a liability, if anything, right? So you're basically getting involved with real estate with no asset on your balance sheet, in my opinion, assuming you're coming from one of these Western worlds. Okay, guys, let me go ahead and do some shout outs. I need to get over to the member live stream. So we've got Mary Henderson, Scuba D, FNS, Fire and Ice, Ol Rocker, Devin, Chase, Allen, Brian, Tavares, Angelique in the house. We'll probably see her over on the member live stream. Brothers Awakening, Carlos, skipped on me here. RR in the house. Robert Broker, Zach Shielder, or Shedler, Shieldler, Shafi D, John Liano, Eric, the Hall of AB. That definitely gets the award for today's most original creative username. Brendan O'Brien, Bob Porras, Ol Rocker, Art Oseguera. All right, guys, enjoy the rest of your evening, and I'll see you on the next video.